Hey everybody, Chris Engelbert with Engelbert Financial Advisors in beautiful Allentown, Pennsylvania. We do it every month. We're doing it again this month. This is the November update for 2023. And I always start out with a cartoon. And obviously, if you're a Phillies fan like I am, we did have 3 strikes and you're out. The Phillies did not make it to the World Series. So you can see by my shirt, I've rolled right into Eagles. And obviously, we're very happy about the Eagles. But why did I bring up the 3 strikes, you're out? Well, guess what? The S&P 500 is literally down 3 months in a row. It was down August, September, and October. But wait, when the calendar changed November 1st, we've had a very powerful rally, literally almost a 7% rally. The S&P 500 was up 7 days in a row. It hadn't done that for 2 years. And again, our risk indicators got pretty compressed by the end of October, which made us very confident that we're going to see more positive action in November and December. And sure enough, like I said, first 7 days of November, we're straight up with a nice rally. So what's going on with interest rates? Well, guess what? One of the reasons why the S&P 500 rallied when the calendar turned in November is because interest rates are coming down. At the end of October, they were 4.8%. Everybody was worried about the Fed raising interest rates. Well, sure enough, interest rates are beginning to soften up because we are getting a few softer signs in the U.S. economy. We don't think it's the purveyor of something really bad to come. We just think the economy has been doing so well that it's bound to take a rest sooner or later. But guess what? What happened was that interest rates started to come down. And you can see that right now, Treasury yields are around 4.5%. So some good things have happened in the first part of November so far. And then we're looking ahead to 2024. And here's an interesting slide. On the years that the S&P 500 does not record a new high, like it did this year, there was 41 other times it didn't record a new high. On average, on the year that the S&P 500 didn't record a new high, you can see that the following year, there was literally around a 10.4% return. That's getting us more bullish for next year because we think there's a lot of things on the horizon that investors are not paying attention to, especially good things. Everybody's been paying attention to the bad things, obviously the conflict in the Middle East, higher interest rates, possible slowdown in the economy, the Fed, I can go on and on and on. But what people aren't paying attention to is that employment is still strong. We had third quarter earnings on the S&P 500 was up 7%. Nobody expected that. And in fact, last year at this time, if you remember, many market pundits were calling that the U.S. economy would be in a recession already by 2023, and it hasn't happened yet. So we're seeing more sunshine than gloom going into 2024. So October was the third down month in a row, but when the calendar turned, the S&P 500 and many of the other stock indices popped, and they popped rather dramatically. Third quarter earnings, like I said, were better than expected. Now we're starting to get some initial reads on fourth quarter earnings, and they seem to be still up for the year. So we think 2023, as far as earnings on companies, are going to be better than what anybody expected. The yield on the 10-year Treasury is attractive. And now one of the things that investors are going to have to determine going into 2024 is how much money do they want to have in bonds. We haven't seen bond yields at this level for almost 15 years. You can get a risk-free rate of return in a bank CD for 3 months at 5.3%. But if you go farther out on the yield curve, especially in the mortgage-backed area, you can get upwards of 7.5%. So many people are lamenting about the fact that, gee, if I go out and get a mortgage right now, I'm paying 7.5% for a 30-year mortgage. Well, guess what? If you're an investor, 7.5% on a longer duration mortgage is actually very attractive. So we think that next year people are going to be looking at fixed income in a very serious way because now it's much more attractive than it has been in the last 2 to 3 years. And again, the forecast for the economy is that everybody's expecting us to go into a recession, and they were expecting it in the first quarter of 2023. It didn't happen. They were expecting it in the second. Didn't happen. They were expecting it in the third and fourth. So far, it hasn't happened. Now, the real question is the Fed is trying to engineer a soft landing in the economy, meaning that we don't get a recession. And I have to say, that many market pundits are like, the Fed never gets it right. They're always too late or too early tightening interest rates or loosening interest rates. They might have done a good job this time around in spite of themselves. And right now, it does look like possibly a soft landing for 2024. So that's our November update. A lot more positives than negatives. We'll be back next month. We'll talk to you soon.